I built a multi-million dollar property portfolio before 30, and now I'm in the end game. Here are the hard lessons I learned that people don't know or won't tell you. We've all heard the gurus online. Buy one, draw equity, buy another, rinse, repeat, and print money, right? Wrong. You're limited by a couple of things when you want to grow your portfolio: income and the market. One of the biggest things I learned on this journey was that you don't earn much money, you can't get much property. The banks will cap you hard on how much you can borrow. And then if you don't earn more, you have to wait until the market picks up, rents rise, and your capital growth and equity increases. Then you can grow your portfolio, but you're at the mercy of the markets, and this could take a few years. If you're running this like a business, your main wealth creation vehicle, maybe keep this in mind. So why do some people seem to grow so fast? Well, it's about income. They probably have a huge income and a lot of savings. The more you start with and the higher your income, the more you can buy. For example, we grew so quickly because we didn't have any previous debt and just bought investment properties. We were able to max out our loans because we didn't have a mortgage, car loans, or anything, and our income serviced a decent amount of the debt with the banks. It's like this bucket. The bucket represents your borrowing capacity and your income. Now, you have to bear with me here. It's a little bit awkward. But the bucket represents your income and your borrowing capacity. Balls represent the properties. So bigger balls, bigger, more expensive investment properties. Smaller balls, smaller, more affordable investment properties. Now, you can fit a lot more little balls in, maybe a medium-sized one, if you've got an empty bucket. But if you want to try and buy big ones, it's going to be harder to do when there's already full of other balls in it, right? So it's just something to keep in mind. The bucket can only contain so much, and how you divvy up whether or not you buy big properties or small properties or expensive properties and cheaper properties really depends on how you want to stack your bucket. But the problem is you can only grow your bucket so fast. You can't just increase your income by, 5 or 10-fold, or everyone would do that, right? So it's just something to keep in mind when you're growing your portfolio. But if you want to carry more balls, get a bigger bucket. But it's not that easy, because if you could just make more money, you would do it, right? So the takeaway here is that the income is the engine that drives the portfolio growth, and real estate is a good investment, but it's where you park your savings in your income. So the higher your income, the larger your portfolio can be, or the bigger your bucket, the more balls you can put in it. Lesson 2, you can grow your portfolio or have cash flow, but not both. When you want to grow your portfolio by drawing equity, you massively shift the yield percentage. For example, I bought a regional property for $150,000 with 7% yield. The banks took a very nice valuation, and 2 weeks after settlement, I took out $64,000 of equity. Hooray! I used that money to buy another property, which grew a lot as well, which was awesome. But that equity redraw took me from a 7% yield to a 4.5% yield, because then I had way more debt on that same property, and I couldn't just jack up the rent, so the property went very negative, and it's been negative ever since. Not saying this is a deal breaker and that you shouldn't do it, because that other property has made me a lot of money. So my cash on cash return, when I think about the $30K deposit that I put in, and then I've taken out the $250K from that other deal, that's a huge cash on cash return. But I've been pumping money into this underperforming property for such a long time. But if you include the holding costs, the deal looks a little less impressive. This is just one of those lessons that you don't learn until you feel the pinch. Yes, growing so fast and having a large portfolio is great, and it's allowed me to do a lot now. But when you grow too fast and compound that across a multi-million dollar property portfolio by 30, here's what I mean. Your whole portfolio can cost you a lot of money. At one point, we were paying negative $90K a year to maintain this big portfolio. We grew so fast. So just keep that in mind when you want to grow your portfolio and scale quickly. Rents can only go up so fast, and this will hurt your bottom line. And lesson number 3, know when to sell and don't get emotional. Now, this is an interesting one and very recent for me, because you could argue either way. Hold indefinitely, never sell, property only goes up, etc., etc. But I'm here to tell you that you might actually be better off selling and allocating capital elsewhere. Let's say you own a block of units and it's doubled in value. Great. But now let's say you have $1 million in equity, just to make the numbers easy. And because everything else is principal and interest now and the rates have gone up, it actually costs you $5 or so grand a year after all of your costs to hold it. Even if it becomes neutral for argument's sake, it still proves my point. Now, gurus will tell you, hey, it costs you very little and it's a tax offset and you have the upside of any future growth. But let's think about that capital allocation. That's a minus 0.5 return % on your capital. Whereas if you had that same $1 million equity, but you put it into an ETF, you could be making $100K a year just by putting it in the markets. That's assuming you're going to get a 10% return. And yes, you do get the paper gain. So let's say that's gone up so much that it's worth between 1.5 and 2 mil. In theory, you're getting $150,000 to $200,000 a year in capital growth, but that's on paper gains and you don't realize anything until you sell it. So it's just one thing to weigh up and think about where are you best allocating your capital. So yes, you do get the paper gains of capital growth, but some years that's big and some years it's flat. So when you find yourself in this situation, maybe you're better off selling, paying your exit fees, and reallocating the capital to something that performs a bit better. The other downside is that you have over $1 million betting on one town or city, wherever that property is. That's a lot of money to have in one allocation or in one investment. It is just hard to let go. I'll admit that, because your property portfolio can be like your baby and you don't want to sell your baby. You worked hard for that and you still have to pay your exit fees, which is a downside. Buying property shouldn't be an emotional decision. It's the same with selling. Just cut the numbers, and if the math makes sense, then do it. Don't hold on to underperforming assets because you're attached to them. I actually lost money on a property because of this. It was the first property I owned, but it was tying up cash flow and borrowing capacity. So I sold it at a loss because I didn't want to carry that forward until maybe one day it went up in value. So I recycled the money into something else that made me a whole lot more than the $30,000 that I lost on that deal. You might lose the battle, but you will win the war. To recap, I built a big portfolio and learned that it's not an infinite money glitch. You can have quick growth or cash flow, but not both. And you need to know when to sell and when not to get emotional. I spent 20 years chasing passive income, and here's what I've learned. So head over and watch this video right here. Give it a watch. Thanks.